What is up guys, my name is Ignas, welcome back to the channel. Today we are taking a look into a large pharmaceutical company, Bristol Myers Squibb, ticker symbol BMY. They looked pretty horrible in December of 2021, where the price started at just under $55 per share, but then a surge of over 10% followed, and the year was finished at $62.35. As for the first part of January of 2022, the stock is now at $64.56. This suggests that we are getting closer to the 52-week high, which is currently at $69.75. And if we take a look into the 5-year chart, the stock is up for 15.09%, so the growth is not that huge, but they are paying a dividend where the yield is now at 3.34%. So should we consider buying into Bristol Myers right now? First we will take a look into the latest earnings, then fundamentals and financial ratios, after that where analysts think the stock should be trading, then the moves of Superinvestors and insiders. After that I will share my own trades in Bristol, and lastly we will check into the technicals of the price chart. Hopefully these steps will help us determine whether we should be buying or staying away from the name. Bristol Myers Squibb develops, licenses, manufactures and markets biopharmaceutical products worldwide. The company offers products in hematology, oncology, cardiovascular, and immunology therapeutic classes. They have a range of products including Revlimid, Opdivo, Orencia, Abraxane, and others. The company sells products to wholesalers, distributors, pharmacies, retailers, hospitals, clinics, and government agencies. It has collaboration agreements with Pfizer, Otsuka Pharmaceutical, Ono Pharmaceutical, and others. So how is the company performing recently? On the third quarter earnings, Bristol Myers reports 10% quarterly sales growth as cancer drugs rebound. So on top line they reported $11.6 billion, just over analysts' expectations at $11.58 billion, and then on earnings they got $2 per share, which was 8 cents over expectations at $1.92 per share. Sales are growing despite the increase in COVID-19 cases, which one would think could have kept people from seeking treatment for other diseases. The prospects also look decent. As for the immuno-oncology patient volume, we are still about 5 to 10% below where we were pre-COVID, but the trend is moving in the right direction. And Bristol is also continuing to look at expanding its pipeline of medicines in development through deals mostly involving smaller early-stage companies in areas such as cancer, immunology, and cardiovascular health. So it seems that the quarter was a success, and the prospects going further are good. But let's check if that was the same case for Bristol Myers before. These are here the revenues for the last 5 years. So back in 2016 they had $18.47 billion for the trailing 12 months. Then in 2017 that was at $20.57 billion. 2018 it increased to $22.03 billion. 2019 that was at $24.17 billion. Then going to 2020 we saw a huge increase to $39.39 billion. And now for 2021 on the trailing 12 months we are sitting at $45.46 billion in revenues. So in a span of 2 years we went from $23 billion to almost double that at $44 billion. And then if we take a look into quarterly revenues, the last one under $10 billion was back in 2019, and then the next 7 quarters were all over $10 billion. But why was there such a huge increase in revenue by the end of 2019? A quick Google search led me to this. So by the end of 2019, Bristol Myers Squibb is buying Celgene. By raising one of the industry's most active partners, the $74 billion deal promises to shake up biotech for years to come. So it seems that that huge acquisition led into this revenue surge, but even before it, going from 2016 to 2019, we've seen that gradual increase too. So hopefully it will continue on growth and acquisition path for years to come. Now another part I would like to take a look into is the price to earnings. So back in 2016 it was at 18.82, as earnings dropped in 2017 we had it at 88.09, then in 2018 earnings came back up, but the price decreased, so the PE was at 15.55, then in 2019 we had an increase in price to almost $6 per share, so the price to earnings increased to 29.77. For 2020 and 2021 earnings per share for the trailing 12 months are in the negative. This means that as the price have been increasing, earnings remained in the negative, thus there is no PE ratio actually available. So it seems that it was a good idea to buy in back in 2017, where we had a dip at $46 per share with a PE ratio of 16.22, and then there was another opportunity in 2019 where the price was at $41 and the price to earnings at 11. But right now, with the price going up and the PE ratio in the negative, it doesn't sound at all promising. Next part we'll take a look into are the shares outstanding. So back in 2016 it was at 1.68 billion shares, then in 2017 we had a 2% decrease to 1.45 billion shares, then for 2018 another gradual decrease to 1.63 billion, and in 2019 we had the lowest low at 1.63 billion shares. But then with the acquisition of Celgene we had an increase of 40%, or a number of shares outstanding at 2.29 billion shares. What is promising still is that after that the number was on the decrease, and as of the latest report the number of shares decreased by 2% to 2.24 billion outstanding shares. So even though there was a huge increase, we do understand why that is, and we'll probably be again seeing a gradual decrease in the number of outstanding shares. Now let's also take the dividend yield. So back in 2017 the payout was $1.32 per share with a yield of 2.87%. Then in 2018 the price increased to $55, so the yield decreased to 2.51%. As the payout was gradually increasing and the price dropped to $42.77, the yield surged to 3.43%. Then in 2020, with the price going up to $52, the yield went to 3.08%. In 2020 the price was at $61.61, so the yield was moving lower at 2.94%. And with the most recent increase in payout to $1.99, we now have a yield of 3.23%. So in order to get the best yield out of the last 5 years, we should have bought in back in 2019, where it was at 3.53%, but there were also plenty of times in the last 5 years where we could have bought at a yield of under 3%. So it seems that buying at over 3% doesn't sound that bad. To further check into the yield, I've made this graph in Google Sheets. So here we have the history for the dividend yield in the last 5 years, and at the bottom we have the current dividend yield at 3.51%. So out of all those, the average dividend yield in the last 5 years was at 2.97%, so just barely under 3. This suggests that if we buy the stock right now, we are locking in a yield that is now 18.09% over the 5-year average. And in the last 5 years it was only higher one time, where back in 2018 we had it at 3.53% or 18.76% over the average of the last 5 years. So buying right now, at least for the dividend yield, seems like a decent idea. So what do analysts think, where should the stock be trading in exactly 1 year? On Yahoo Finance we now have 20 price targets of analysts. The targets range from the lows of $58 to the highs of $94 per share. The average is now at $72.03 and the current price is at $64.65. So on average, analysts predict that in 1 year the stock for Bristol should be up 11.4%. We can also check into earnings estimate. So analysts suggest that in 1 year BMY should bring $7.84 per share, whereas we are now at $7.49. If the price to earnings remains the same, that suggests an increase in the share price at 4.7%. Now let's check what Superinvestors are doing with their positions. So currently Bristol Myers is in 8 portfolios, 2 of those has been recently adding, and for example Hillman Value Fund increased their stake by just under 20%, but then the majority of Superinvestors are actually sellers. The largest reduction is from Viking Global Investors, where they decreased on their position by 37.94%, meaning that they previously owned over 11 million shares, or at the current price of $64.50 per share, reduced their stake by over $277 million. So with the majority of Superinvestors selling, that doesn't look great, but there is another apparent issue with the insiders. So in the last 6 months, insiders made 0 buys buys, but they did 15 transactions to sell, totaling at just under $30 million. So this suggests that at least in the last 6 months, smart money has consistently been selling out of the stock. Now let's take a look into my portfolio on eToro. So I currently do not own any shares in Bristol, but I did make 2 trades in it last year. One was opened in July and closed in August for a profit of $1.87, and another was opened in the beginning of December and closed just by the end of it at a profit of $14.49. So overall I traded $200 and got a profit of $16.26, meaning that on these 2 trades I'm up for 8.13%. The price has been surging recently, so I'm not interested in starting a position, but if it drops back lower, then I'm definitely buying back in again, and the technicals will help me decide when to do just that. So as mentioned, I sold out of the last trade on December 30, just as the price was going closer to the 200-day moving average, right there at my second resistance price target. In the next few trading days, the price dropped a bit to my first resistance. There was a bearish crossover in the lines of the MACD, but the relative strength index was still high at 63. And then it seems that on the 6th, we got a dividend drop to the lows of $60.86. But after it we had a huge green candle, with the price going to the highs of $63 per share, right there at my second resistance price target. And as of Monday there's another surge, now to the highs of $65 per share, ignoring my resistance and the 200-day moving average. With the price being overbought and the relative strength index over 70, I will have to stay out of it for now, but if the excitement cools off and the price goes closer to my super targets, then I will consider to start buying back in. Now let us make a small recap of what we learned. So the earnings report was favorable, revenue had a nice increase, and both revenue and earnings beat analysts' expectations. For the last 5 years revenues has been gradually increasing, and the large acquisition of Celgene helped in that huge surge. There was plenty of opportunities to get the stock at a low price earnings ratio, but unfortunately currently we have it in the negative. The company is not only paying a high dividend, but also continuously buying back shares. Buying the stock now would give a dividend yield that is pretty much the best of the last 5 years. Analysts predict that in 1 year the stock should go up from just under 5 to over 11%. There is a bit of an issue that Superinvestors has been reducing on their positions, and insiders are also selling out. Looking into the chart, the recent surge sent the stock over my resistance targets, so I would be waiting for a pullback to start buying back in. And that means the stock needs to go lower for around 10% to get to under those $60 per share. So that is all. I hope you'll get value out of it. Help me out in return and leave a thumbs up under the video. If you would like to know exactly when I buy or sell any stock, then consider memberships. By becoming a member, you will get access to Discord, where I share my stock watchlist and all the buys and sells exactly when I do them. This could be a great option to track my moves closely. Otherwise, if you would like to check what positions I got in my eToro portfolio, then just follow the first link at the top of the description. The previous analysis that I did was on a large semiconductor company, so if you would be interested in that, then click on a video that is currently on the screen. And that was it from my side. Thank you for watching, and I will be seeing y'all in the next one.